Hello, this is Mark Sobel on Fifth. Today, I have the honor and pleasure to be joined by Esther George and David Wilcox to talk about yesterday's FOMC outcome and the outlook for monetary policy. Esther George served as president and CEO of the Federal Reserve Bank of Kansas City from 2011 to January 2023, assuming that position after a long career at the bank, including leadership roles for supervision, risk management, research, public affairs, and human resources. David Wilcox is Director of U.S. Economic Research at Bloomberg and Senior Fellow at the Peterson Institute for International Economics. Before that, David was Director of the Federal Reserve Board's Division of Research and Statistics, where he functioned as the division's chief economist and senior advisor to Federal Reserve Board chairs. And in an earlier incarnation in which David and I both had more hair, he served as Assistant Secretary for Economic Policy at the U.S. Treasury, where I first met him. I'm going to start the first half of this session with a series of questions on the FOMC and the monetary and financial policy outlook. I'll then turn to audience questions, which can be posted in the chat. Today's session is on the record. So welcome, Esther and David. Huge thanks for joining us today.
Thank you.
Good to be with you.
So a month ago, I was expecting a fairly boring FOMC, but then there was a negative jobs number. The Iran war and oil prices surged, some heady PCE inflation data. Notwithstanding, I always begin by asking my guests for a thumbnail reaction to the FOMC statement, press conference, and dot plot. Was it as expected? Any surprises? Thumbs up or down? And then we'll dig into the details afterwards. So let me start with Esther and then David.
All right. Well, thank you, Mark. It's good to be here, and it's good to be alongside David again. We, at one point in our Fed careers, sat at the same table. So I'm looking forward to this conversation. So yesterday's meeting, I think, as you said, no surprise in terms of the rate decision. That seemed well in hand with markets and Fed speakers up until that point. But I think three things. When you looked at the statement, they held the statement pretty constant, acknowledging the war. That was about the extent, I think, of meaningful change. The SEP, I thought, was a little brighter maybe than I anticipated, but my guess is, since they were on hold, people largely kept to an outlook that was brighter, at least pre-Iran war sentiment anyway. And the last thing, Mark, that I think got my attention, the presser at this time really had one real takeaway, and that was a question had been on the minds not only of reporters, but I think many people, which is, what is Jay Powell going to do in terms of his role as chair, given the things that are swirling around in terms of the criminal investigation and the nomination of Kevin Warsh, his time as Fed chair coming up in May. And I think he offered some clarity at this point that I thought was very good. It will serve to stabilize, I think, during a very uncertain time, at least the question of what he will be doing.
Thank you for that. David.
Yeah, I agree with Esther. By the way, Esther, I'm going to struggle not to call you President George, but I hope that'll be okay if I slip
like
and do call you President George. And my take on the meeting would be very much the same as hers. It seems to me that the most notable thing by far to come out of the press conference was Jay Powell, if I may appeal to religious history from 500 years ago, nailing three theses to the door of the Federal Reserve Board, having to do with whether he will stay on past his May 15th expiration of his term as chair, whether he will stay on even after the investigation is resolved. That was the real news to come out of the press conference. I agree with Esther on that.
Okay. Well, 95 would have been too many. So, well, all right. Let's get into the economics of it all and drill down on dual mandate and its legs. Let's start with inflation, and I'm going to ask David to go first. So the Fed targets 2% PCE inflation over the longer run. I wrote a piece a few months ago, well before the Iran war, that the Fed seemed closer to a 3% inflation regime in my mind, not 2%. PCE inflation has remained high. Fed hasn't hit its targets for 5 years, and recently oil prices have risen on the backs of the Iranian attacks, plus arguably greater evidence of tariff pass-through at the beginning of the year. One often hears these days about, well, you should look through the higher oil prices, but then people fret about second round effects and whatnot. So what's your overall take on inflation, and how should we think about surging oil prices in relation to monetary policy? David.
Yeah, at the risk of sounding a lot like Jay Powell yesterday, we simply don't know. We don't know the duration of the war. We don't know the level to which oil prices will rise. We don't know the damage to the infrastructure. We don't know how quickly all that production capacity can be turned back on and production return to something more resembling normal after the conclusion of the war. So to call the current situation uncertain is a vast understatement. But the dominant fact about inflation today is that it's been above the Fed's 2% target for 5 years now. And worse, it's forecasted to stay above 2% for 2026 and 2027, according to consensus forecasts. That's too long for a serious central bank committed to inflation targeting. I continue to believe the FOMC is strongly committed, but it's half of the very uncomfortable situation that the Open Market Committee finds itself in today. So that's what I would really point to in this context of tremendous uncertainty, is the persistence of inflation above the 2% objective and the imperative to get it back down to 2%.
Thank you. Can I just throw a curveball at you? Just one additional question. Sorry. Powell mentioned inflation expectations yesterday. I think he intimated they were anchored. I was wondering if you could just offer a quick bon mot on that, David, and then I'll ask those questions to Esther.
So I was never too good at hitting the curveball when I was in Little League, but let me take a try at this one. For the moment, I'm not particularly unnerved about inflation expectations. Short-term measures have moved up a bit, as one would expect, given the significant increase in oil prices. Longer-term expectations we don't measure very well, and we don't have a lot of post-hostilities evidence about what's happening to those. They don't look, the meager amount of evidence that we have thus far doesn't look particularly worrisome. But again, to hammer on the theme of my view about inflation, the worrisome part is that American households and businesses have just been through a substantial episode of inflation, the worst in 40 years. Their expectations remained remarkably well anchored through that. But at some point, logic suggests that if buffeted by enough shocks, their confidence in the Open Market Committee's ability to and commitment to return inflation in a timely manner to the 2% target, that confidence will be shaken. So if I were, heaven forbid, a member of the FOMC right now, I would be particularly focused on safeguarding inflation expectations and ensuring that that policy asset remains intact.
Thank you. Esther, on inflation.
Yeah, Mark, I think David said this well, and I want to acknowledge something David was involved in recently through the Peterson Institute, of really sponsoring, along with Karen Diamond, some work that looked at this past episode of inflation. What did it mean? What can we learn from it as we go forward? And I think now, as David said, is such an important time for policymakers to be thinking about that credibility that goes alongside their commitment to the 2% inflation target. They certainly have talked about it. I do believe that is exactly where they are aiming. But the question is, how much time do they have to allow inflation to run above that 2% target without risking this essential credibility, without risking what happens with these inflation expectations? So my concern would be not so much this oil shock. I think there are lots of reasons you might say, okay, depending on the persistence of that, you could look through it. But really, the issue is how long this pandemic-related episode of higher inflation is hanging on. And when I think back to the period of the 70s, and there's lots of reasons to think this isn't like that, and I wouldn't disagree. There are many things that are different. There are two things, though, that I think are relevant to thinking about what did we learn from that period and how might that apply now. One is, obviously, we didn't have an inflation target back in the 70s. That, I think, is so important to the anchoring of inflation expectations today. But we can't take that for granted. And the other thing is, if you think back to the 70s, there were sort of two pivot points in that. There was a 73 shock, and then one followed a few years later. And if you can't get inflation down in between there, it sort of undermines, I think, that's credibility that you want along making sure that you're keeping inflation down. So I think the committee does have its handful with this, of thinking about, yes, we have a dual mandate, but so essential to achieving that dual mandate is making sure you have stable inflation expectations.
Thank you. Okay, well, let's switch over to labor markets, maximum employment, the economy. I noticed at the end, towards the end of last year, there were a lot of forecasts for 2026 growth in the 1 3/4 to 2% range. I then saw them bouncing up to 2.5 or so. Now, last week I saw the reappearance of the word stagflation. I'm not sure I think it's appropriate for the U.S., but there it was. The labor market is considered weak and low hire, low fire. The February job losses sparked heightened concerns. But some of the weekly initial jobs claims data is holding up. Powell mentioned yesterday 4.4 fairly constant unemployment rate. I've heard, and I thought something else he said was very interesting. He intimated that the break-even rate was around 0. I've heard other people suggesting, well, maybe it's a little bit higher than that, but it's well south of 50 according to many of the estimates. So how do you see the labor market now and evolving over the course of the year and playing into the dual mandate? Esther, please.
So this, again, I think every sentence could begin with a most challenging data point for the committee. But again, when you think about the committee's assignment around both maximum employment and inflation, this one has certainly been in focus for the committee as we've watched over the past year in particular. One, because that unemployment rate has been going up, but the other is trying to diagnose a very major policy change that also is hitting at the labor market, and that is the shift on immigration policy. So when you try to understand the economy that is responding to higher rates, it's getting back toward an equilibrium. We went from a very tight labor market. Remember, 3.5%. We had 2 job openings for every unemployed person. We were watching wages begin to rise. As that unemployment rate began to tick up, of course, it causes the committee to try to think about, okay, is this a cyclical weakening in the economy? Is this just normalizing? And of course, we've watched their own policy reaction move in the direction of saying we need to be thinking about the labor market as that unemployment rate rises, and they've been reducing the policy rate in doing that. In fact, you continue to hear some of the divide in the committee around the labor market in that context. Is this a weakening labor market? Is it fragile? Or is it, as we heard the chairman say yesterday, maybe it's at an equilibrium? It's the fact that your job market is not growing would not suggest you'd see higher GDP forecasts coming out of the dot plot. So I think it is telling you something about the dynamics of that labor market today, both policy induced, both, again, the economy shifting into a more normal versus a very tight experience that we had before. And I guess my last point on that, Mark, would be it leaves, I think, the FOMC having to think carefully about how much maneuvering room they have around that labor market. In other words, is it on thin ice right now? It may be at an equilibrium, but it may mean that it doesn't take much to tilt it either into a weaker position as we go forward. So those are the things I'd be thinking about with this labor market today.
Great. Over to David. And David, I never heard the term NAIRU anymore. Does it exist?
Fallen out of fashion. If you did a Google search for it, I think it's correct, Mark. I haven't literally done this, but the frequency of usage of that term it probably has declined. I agree very much with Esther's thoughts. I'd just reiterate and underscore a couple of things. The labor market is the other half of the challenging situation that the committee finds itself. We talked earlier about inflation being too high. I think it's pretty clear that the labor market is to the soft side of sustainable. There are a striking number of segments of the labor force who are clearly having a really challenging time. We've all heard about recent graduates from college finding a very, very difficult time to get that first job, the on-ramp into a professional career. But there are other segments of the population. The African American unemployment rate has moved up, and oftentimes that's a bit of a harbinger of a weakening labor market. So all told, I think it's pretty clear that the labor market is to the soft side of where it could be on a sustainable basis without generating unwanted inflation pressures. But there isn't an easy answer to that given the challenge on the inflation side of the dual mandate. So I'll leave it at that.
All right. Well, let me carry on and let me try and put some words in your mouths. I hear more concern about inflation from the two of you than I do about the labor market, but you can correct me if I'm wrong. But in any case, where would your N26 and going into 27 dot plot stand? I'll start with David this time.
Well, I'll invoke one of my father's favorite sayings, which was that in some circumstances, the right answer is don't just do something, sit there. So my dot plot would be firmly on hold for the foreseeable future. It's a murky, difficult, challenging situation. I don't think there is no textbook answer to this situation that extracts a central bank from the predicament in which the Open Market Committee finds itself. Not a textbook at the 101 level, not a textbook at the grad level. So for me, particularly given the extremely enhanced level of uncertainty at the moment, I personally would be strongly advocating for staying put. I think policy is, roughly speaking, in a good place right now, and I would wait for some development, hopefully, to clarify, and best of all, for the extraordinary level of uncertainty to diminish.
So no cut, not one cut.
Not one cut, no cut.
Esther.
Yeah, I think I'd be in the same place, Mark, of no cut in my dot. I think I thought it was interesting to hear the chairman say, just as we skipped the SEP during the pandemic, this might have been a good time to do it. And I don't think, obviously, literally, that would have been appropriate. But I do think it is to the point of saying when things are uncertain, you tend to stick with an older baseline, the past baseline, to say moving one direction or another would signal more certainty than any one participant has. I think, for myself, I was not a big fan of doing cuts in 26, even before the conflict broke out in Iran, in part because of this inflation issue. And not because I don't worry about the labor market. I think, to be clear, the labor market has created a dynamic that is coming from multiple sources, for everything from our demographics, immigration, and all that, which makes one question, what exactly is monetary policy positioned to do relative to those dynamics? But I think on the inflation side, would have felt much more important to me to really try to think about what do I think the long run Fed funds rate is in the context of this dot plot. And I thought it was interesting looking yesterday. I went back just to remind myself of the dispersion around those dots when it comes to the long run.
Mm-hmm.
There are people that have situated that back to where we were pre-pandemic all the way to, a pretty high, something getting closer to 4% in terms of a neutral rate. So I think trying to judge where you're headed relative to what's neutral, at a minimum, I think warrants sitting tight during this time of uncertainty. And I certainly would have been there, as David said.
Thank you. Well, let's shift gears. And I'm going to pose maybe a long-winded question that reflects my mental meanderings about a topic that I don't well understand, but it's the Fed's balance sheet. And I'll start with Esther. But Kevin Warsh, Scott Bessent have advocated for shrinking it. In my simple ex-Treasury mind, it raises architectural and plumbing issues. On architecture, there's widespread acceptance that QE is appropriate in a crisis. But I've spoken with some people, even from the Fed, and they've argued that the Fed's footprint in the Treasury market, it's too big, and it leads to excessive reliance on the Fed and expectations it will offer a put for Treasuries in times of strain. They argue the Fed's balance sheet could be brought down more quickly, and some point to the Bank of England and the RBA as having done so. But then on the plumbing side, I hear it said that ample reserve regime is working well. Smaller balance sheet could create more volatility between the floor and the ceilings, and it could cause strains. And some say that shrinking the balance sheet could put upward pressure on rates. So I guess I hear this view that, well, the ample reserve regime works. If it ain't broke, why fix it? So should we stick with ample reserves, or should the balance sheet be shrunk more quickly? And I'm not saying going to a scarce reserve regime overnight or anything like that, but how do you assess the trade-offs and the underlying policies?
Yeah, I think, Mark, by the nature of how you've posed this question, tells you how thorny this issue has been for policymakers, which is the shift going back pre-great financial crisis to that scarce reserve regime where the Fed had a very small footprint. In fact, I can remember for many years, sort of the mantra, the philosophy was you want the central bank to have the smallest possible footprint in the financial market so that the market is taking care of longer term rates. And of course, by necessity, I would argue, although I was not a fan of many of the QEs, they are appropriate tools, I think, when you get into a time of crisis. The question, I think, is how long do you stay and how do they morph from a crisis management tool to a tool of monetary accommodation? And we saw that most recently during the pandemic period. So you remember, obviously, the market functioning became a tremendous issue. And the Fed stepped in a very large way to do that. I was among those that supported that decision. But as you watched over time, the statement began to broaden out to say, we're doing this both for market functioning, and we're doing it to provide accommodation to the economy. And I think there is where there is opportunity to really clarify, what does this tool do? What does it mean? Because it carries with it, as we've seen, political economy issues. It carries with it not just the impact when you go in, but what does it mean to step back from that? And of course, you connected to your question the ample reserves regime, which again, by necessity, this committee had to think about how are you going to control interest rates as you came out of the financial crisis, when you had this abundance of reserves in the system, you had new regulation that was pushing banks to hold more liquidity on their balance sheets. That confluence of change, again, led the committee to lean toward this ample reserves regime, which again has its own elements of uncertainties. I've heard the arguments, it's easier, it's working, why mess with it? I don't think that's really the right way to say what's the appropriate and the most efficient way for the central bank to try to work within the financial system, provide the crisis management essential role that it has to play, and also provide reserves to the banking system. So I think that's an area ripe for looking at. I'd love to see, central banks question that, to say, we know what scarce reserves look like. Now we're over here on the other side of ample. Are these optimal policies for us to conduct policy? So a lot yet, I think, to learn about the use, the role of QE as we look ahead to the future. And again, we're in a time fraught with political economy issues. And those seemed obscure back in 2008 and 9, but now we're living through those. So I think a lot to think about with that.
Great. David.
Yeah, I've been looking for some element of this conversation where there might be even a glimmer of daylight between Esther and me, and I think I detect a tiny glimmer of daylight.
Go for it, David.
Look, I have no problem whatsoever with putting the balance sheet on a long-term trajectory toward getting back to even an all treasuries composition. I really don't have a strong view about what the maturity composition of the balance sheet in the fabled steady state that we may get to at some point, as to whether that should be all in short-term treasury bills or in a composition that mirrors the holdings of the non-Fed public. Those, it seems to me, are fine issues to talk about, but ones that I don't have a strong view about. Where I do have a pretty strong view is I think it would be a tremendous mistake for the Federal Reserve to give up the option of exercising balance sheet policy when the federal funds rate is pinned at the zero lower bound. To be clear, I didn't hear Esther say that, but there was a reason why then Chair Ben Bernanke introduced large-scale asset purchases into the toolkit of the modern Federal Reserve into 2008 when the funds rate hit zero. The committee at that point was handcuffed. It had no additional way to provide support to the macroeconomy through its conventional tool. And this was a way of bringing down longer-term interest rates and supporting what proved to be a too anemic recovery from that awful collapse. I'm very much in favor of the Fed staying within its legal mandate, but there is no question that large-scale asset purchases are within its legal mandate. And so my view is that it really is incumbent on the FOMC to exercise this tool. And I would hate to see the FOMC pre-commit not to use that tool to support the economy. One other area where again, I didn't hear Esther, so don't misunderstand me as suggesting that Esther had said this, but I've heard other people who object to the Fed's use of large-scale asset purchases. One of the complaints sometimes lodged is that the Fed has enabled a profligate fiscal policy. I just don't see any evidence of that whatsoever. It seems to me the Fed needs to stay in its lane of executing on the dual mandate, maximum employment and price stability. And it is up to the Congress to ensure that fiscal policy is conducted in a manner that is sustainable and makes the appropriate trade-offs between the near term and the long term. I think there is essentially no dissent among, or exceedingly little dissent among people who pay attention to this, that fiscal policy currently is not on a sustainable trajectory. That's an important and serious problem. It needs to be brought under control. That will be politically painful. That is not the Federal Reserve's problem to solve. It is up to Congress. The analogy that I would use here is the following. Think of somebody handing the Congress a credit card with a $500 credit limit. Do we really think that Congress would have maxed out on the credit card up to the $500 limit any slower if the interest rate on that credit card had been 19% instead of 18%? I don't think so. It really is important. It's incumbent on our elected leaders in the legislature and the White House to put us back on a sustainable fiscal trajectory. It's important for the Fed to execute on its dual mandate. Those two functions can be separated, and in my view, ought to be separated.
Okay, well, thank you for that. I think there's agreement that in a crisis or zero lower bound that QE is an appropriate tool. I think Warsha said that. I guess one question in my mind, but I'll just leave this hanging and I'll move on, is, if fiscal is such that interest costs and the deficit surge and it creates financial problems, does that put the Fed in an awkward position from the financial functioning point that Esther mentioned? But okay, well, that leads naturally into my next question, which was just a softball for the two of you. It's about central bank independence. We're running these massive fiscal deficits. The president argues the Fed funds rate should be lower and provide the U.S. government with cheap finance. He's attacking Powell. There's the Lisa Cook case. I've always said that the Fed independence is a misnomer, and it's really not helpful because the Fed does operate in an accountability framework. The executive branch nominates the governors, Congress approves them. But what the Fed has is instrument independence that refers to the Fed funds rate and the balance sheet. So how worrying are attacks on the Fed in your minds? I mean, for example, is the Fed a weakened institution already because of the current administration? And then the thing I worry about, which harkens back to the previous question, is kind of fiscal dominance. Could that ultimately compromise monetary policy instrument independence? So, David.
First of all, I agree, Mark, that the word independence is perhaps unfortunate. It suggests that maybe the central bank is a rogue institution operating, or that somebody thinks it ought to be a rogue institution operating without any accountability to the Congress. And that's not right. The problem is, from a communications standpoint, a more complete description of something like instrument independence, which means that the Fed has the freedom to operate one step removed from the political partisan day-to-day fray. That's a bit of a mouthful. And so when I slip into using the term independence as a short moniker for the concept, what I really mean is that more elaborate concept that involves, yes, an important element, absolutely, of accountability. And I think what we've seen from the Fed consistently has been that. You asked how concerning is this current situation? I guess my view is that it is concerning, but not right now not particularly alarming. I want to pay homage to Chair Powell's leadership. I think one of the incredibly important things that he's demonstrated is that it is entirely possible for the Fed chair to lead an institution through an incredibly difficult environment and retain credibly that independence, that ability of the Fed to make monetary policy decisions one step removed. It's a little puzzling as to why the administration thinks it's in their interest to hammer away at the Fed, because if anything, it seems to me it's more likely to cause the Open Market Committee to tilt ever so slightly against complying with the administration's wishes in order to demonstrate that they're not just caving to the dictates of the White House. My concern actually focuses over the slightly longer term. There's been an awful lot of concern about various attacks, the effort to dismiss or remove Governor Cook, for example, the subpoenas of Chair Powell. My concern there was at an 8. Now it's at a, roughly speaking, at a 4. So I don't think those attempted prongs of attack are likely to be successful now, pending an opinion from the Supreme Court. Where my concern is still at a 9 is on the ability of this president or any president to overtake the institution through the most conventional of possible means, namely the power to appoint. The power to appoint over time accumulates, and it turns out it's not just incremental one more at a time. There is a tipping point at 4 members of the Board of Governors. We can go into why that tipping point of 4 members of the Board of Governors concerns me so greatly. But for this reason, I want to come back to what Chair Powell said yesterday, that he will stay until at least until the investigation is concluded, and that he holds open. He hasn't made up his mind what he will do after that. And my hope is that other members of the Board of Governors will see that leadership by example, and that they will do their utmost to see the institution through this moment of extreme peril over the longer term.
Esther, please.
Yeah, well said, David. I think, Mark, I love your framing, because increasingly I have used that in my own public comments, which is less focused on independence, which often is interpreted as we can do whatever we want, and more on the accountability, and a reminder that Congress actually has the authority under the Constitution for our money in the United States, and has delegated to the Fed with some pretty clear mandates what its job is in doing that. So I think it's important, just in a general public communication, to be clear about what that means. I also have long defended, presidents well before Donald Trump have aimed at the central bank, have advocated for lower rates. We all know the history and examples, including, a very popular former president right here from Missouri, Harry Truman, that agitated for lower rates. I think what concerns me today, and maybe my concern is higher on the meter than David's in some respect, is that this president has not just talked about and challenged the Fed verbally, but has begun to take real actions to try to influence both the appointment of governors, the public confidence in many respects, in a way that we haven't seen before. And that does concern me for the Federal Reserve. Having said that, I think the institution is sturdy. It is holding, in terms of making sure it's acting in the broad public interest. But many of the parameters that designed this institution to provide that political insulation I think are important and have not always been in place. So David's concern about the appointment of governors, whether 4 is the tipping point under one administration, is because these 14-year terms have shortened up in terms of how long people actually stay, which again has undermined a bit some of that insulation in terms of how the process can work. So I just don't take for granted, having not imagined that I'd see some of the things I see today, that you don't have to be super vigilant. And I do lay this at Congress's feet. They must be super vigilant about the institution, its design, and making sure that every decision that the
Did Esther freeze up? David, are you there?
Yeah, I'm here.
So
And
Esther's frozen.
yeah.
All right. Well, let's hope she comes back. Well, in the meantime, let me move on to some other questions. So a member of the audience has asked about suggested tariff pass-through has been limited, but how do you think firms are going to react to the surge in energy prices?
Well, it's a good question. My guess is that they will perceive exactly what the Open Market Committee perceives, which is an environment of tremendous uncertainty. They will feel the same reluctance to make irrevocable decisions now in light of the increase in oil prices. So my guess is that the first order effect is that the higher oil prices will induce a sort of decision gridlock, that their hope will be just as fervent as the Open Market Committee's hope is that the uncertainty will resolve. What we know over the longer term is that if oil prices persist at this higher level, or go up even further from here, we should acknowledge that possibility. Then those companies will pass those additional costs through. And we're already seeing some element of that through things like fertilizer prices and myriad other knock-on implications of the Strait of Hormuz being closed effectively. So what we will see eventually, if the higher oil prices persist, that will be passed on to downstream customers.
Great. Esther, you're back. I see. You
Sorry
were
about
finishing, not at all. You were finishing up on Fed independence. I didn't know if you had Fed instrument independence and accountability. I didn't know if you had any final word.
No, I know. I think I was on a roll and I probably said all I needed to say on that one. So thank you.
I mean, the questions come in. I mean, I think you kind of said the central scenario in your brain is just to stand put until you gain more information and no cuts for the time being. But you know, I don't know if you had any supplemental thoughts, in particular, I guess, about how you think about the balance between the two legs when they are seemingly in conflict. Esther, since David answered the last question, we'll start with you on this one if you have any thoughts.
All right. So I guess I go back to when you talk about conflict between the mandates, obviously, I think it's fair to acknowledge there are risks to both. You know, we have a labor market that could be, as I said earlier, on thin ice. We have an inflation issue that I think has to be addressed. I think in the long run, I think back to a presentation going back to the early 80s that the Romers did at Jackson Hole, which was a reminder to central banks that if you want to have maximum employment over the long term, providing low and stable inflation is your best path there. And so it's not to diminish a labor market mandate. It's not to put more weight on the other. It's to really think about where the central bank can more directly affect its its mandate. And certainly it has a direct line, I think, to the inflation. And this central bank has been very careful not to unseat the employment side. You don't want to go through what people often remind me, which is the Fed usually can tackle inflation at the risk of turning the economy upside down and putting it in recession. So I think the Fed has tried very carefully to maintain a balance of thinking about the direct impact it can have on inflation while also honoring that maximum employment mandate. And I think now the contention here and the tension, I should say, is with thinking about the persistence of that inflation and how long they can leave that there. And again, because I would agree with David, we don't see inflation expectations unanchored, but we have seen them drift up. And the question is, how comfortable can you be with upward drift when you're sitting at this stage? So it is a difficult time for sure in trying to assess where to lean, and it's why it makes it easy and I think appropriate just to sit still for a bit as you watch the data.
David, any additional thoughts?
I'm in wild agreement with Esther on that.
Yeah, let me throw some other stuff at you and see if we can increase discord. So I think it was about a year ago, and sorry if I'm putting words in his mouth, but Kevin Warsh criticized the Fed for excessive use of data dependence and forward guidance. So when I heard that, I thought a lot of uncertainty. Those are key guideposts for the Fed, especially in times of uncertainty. If not data dependence and forward guidance, what else? But what are your thoughts on this matter? David?
Well, one thought is that if Esther were a senator from representing the state of Missouri, I would be encouraging her to explore this with nominee Warsh when he comes up for confirmation hearings. I'd love to see the Senate unpack what exactly he has in mind with that. I'm frankly a little puzzled by what I've heard. There is a way to read his comments in this area as suggesting that he doesn't think the FOMC should respond to information about developments in the economy systematically. That's what I hear when I hear him criticize data dependence. Now, I doubt very much, quite frankly, that that's what he thinks, but I'd love to have him unpack it more thoroughly. My puzzlement is enhanced by the fact that he oftentimes goes on to suggest that forecasting is a fool's errand. And if we don't look at backward-looking information about where the economy was, if we don't attempt to peer forward, yes, with all our limited ability as to where the economy is headed, I'm really kind of at sea as to how one is supposed to navigate the monetary policy ship. So I think this is a really important area for Kevin Warsh to put his views on record. I'm open-minded. I suspect there's probably a reasonable case to be made. I haven't heard it fully articulated. My guess is that Krishna Guha, and I'll put in a plug for a Bloomberg product here. Krishna was a guest of Stephanie Flanders on her podcast called Trumponomics. And Krishna said that his best guess is that what Kevin Warsh has in mind is 50% Alan Greenspan and 50% Stan Druckenmiller. Alan Greenspan as being the person who can peer into the data entrails more deeply than anybody else and see patterns and draw conclusions in a way that nobody else can. Stan Druckenmiller, in being one of the most astute market analysts alive and being able to discern market-based signals. That sounds great, but as Krishna himself went on to say, it's really hard to be Alan Greenspan, and it's really hard to be Stan Druckenmiller. So it's not obvious to me that even if that's the aspiration, that it is realizable. I hope he'll explain more fully what he has in mind in this area, Mark.
Great. Esther, are you in violent agreement with David?
Yeah, I guess first, I'm in violent agreement that Congress needs to be very serious in its questioning of this nominee about the philosophies, the approaches to be taken, and all that. I would love to see a real serious vetting of this, just like I would of most any nominee that comes forward. But I think this one in particular, an important question to ask. I think I'll be a little more generous with Kevin Warsh's views because what I hear in them is a question about communication. So forward guidance as a tool, data dependence, I would advocate have been important aspects of what the Fed has had to deploy at different times. The question is how it's communicated. And I go back to the Fed's objectives are really long run objectives. When you look at the Federal Reserve Act, those objectives talk about being able to achieve these long run outcomes for the economy. And of course, in the short run, in the medium term, you have all kinds of factors that are influencing that. I wonder if the point, and again, this is where I think during the hearings, this could be pulled out. Is it about how the Fed communicates? And I think we could go into a whole conversation about where the opportunities are for the Fed to think about its communication, how it communicates. We go around the block here on dot plots and what they mean relative to what the committee's going to do. So I will take, the critique about forward guidance and data dependence to say maybe there is something in the communication coming out of the central bank that might clarify, whether the central bank is tying itself to a mast that in the face of changing circumstances, it can't, react to for credibility reasons, or whether data dependence suggests it's too backward looking. I mean, David is right. You must look forward to you have to understand where you're going before you can really interpret your appropriate policy actions. But I'll give the nominee that to say maybe there's an opportunity there, but I do hope that will be vetted carefully by Congress.
Okay, so we're approaching end time, and I had two more questions. So I'm going to ask David to answer one and Esther to answer the other. So Esther will get a question on financial stability, and David, a question, a two-parter, just briefly. Two distinct questions, actually. One, how should since you talked about Alan Greenspan peering, you brought this on yourself. How does a productivity increase? How should it be reflected in monetary policy? And then, if you had anything that you would like to say about a subject that I know is near and dear to your heart, which is the state of statistical systems in the U.S., given all the flap around the Labor Department recently. But brief.
Yeah. Actually, Mark, let me be what my deceased attorney father would say is a non-cooperative witness. I'm not going to answer your first question in the spirit of brevity. I'll address the second one.
Okay.
Look, I think one thing that's underappreciated is the value of the federal statistical system to the well-being, the economic and material well-being of not only the United States, but of the global economy. The U.S. statistical agencies were and remain leaders in their field. It is essential that we provide them with the resources that they need. And we talked about earlier, independence, the buffer zone of distance from direct political control in a credible manner that allows their output, the data that they produce, to be perceived as what it is in fact, which is their best technical take, not infallible, but their best professional judgment about what's going on in the economy. There is plenty of reason to be very concerned about this. There are steep drop-offs in employment, particularly at the BLS. There is an alarming degree of vacancy at the most senior positions at the BLS. They are not mistake-free, as we've seen. They have scored some own goals lately, but the response there is to redouble. The proper response is to redouble the urgency of getting on with the task of creating the federal statistical system of 2050, not to hobble the agencies further. It's essential for our economic well-being that that's the approach that we take.
Thank you. Total agreement there. So Esther, financial stability and soup and reg. I know you have a long background in this. We saw the Silicon Valley Bank, we saw Archegos. There's all this talk about private credit, and maybe it's not all systemic, but it kind of raises questions in my mind about whether we're adequately prepared to deal with non-bank financial intermediation is one dimension of the question. And then the second dimension is that, after the global financial crisis, and I know I worked a lot of this through my work through the Financial Stability Board and pushing higher capital standards and the like, but which was great. But we've seen recently the efforts are being made to somewhat lessen capital standards, and I saw that the Fed is thinking of cutting its soup and reg staff by a third. And I was wondering just how you felt about this, and do you think do you have financial stability concerns? Do you worry we're forgetting the lessons of the global financial crisis?
Yeah, it's a great question, although it's not the official mandate of the Fed. Financial stability is critical, and we had a bad experience in the not too distant past with the great financial crisis around this. I think today, I look carefully. The Fed has a very good financial stability report that it issues, which highlights the vulnerabilities. And that's about the best you can do, is to know what's vulnerable. Right now, we have elevated asset prices, which tells you any one of the triggers that also they describe in this report could be the match that sets off something in the economy. And so you can never be highly confident that when you have those vulnerabilities that you're not going to have to pay very careful attention to that. When you combine that with a time when we're trying to deregulate, and again, I am all in favor of getting regulation right and efficient and fitted for purpose. But we do have markets today that have moved outside the regulatory perimeters. They have moved in a way that makes it hard to see where we have vulnerabilities. And so we've intertwined both the banking system with that. And I think now is a time to be very careful as you try to right-size regulation, that you don't undermine that very, very important shock absorber called capital in the banking system. And that, I think, is a lesson that we learned the hard way. And I hope we don't lose that as we look ahead to whatever opportunities there are to get regulation better sized.
Any worries about cutting soup and reg staff?
I don't know that there's a right size. The question is, where are you aiming it? What parts of the system are you taking people out of? Does it mean they'll be looking less at something? Or, did you really have that kind of redundancy? So I don't have enough insight to know where it hits, but it's a big reduction, I think, and almost always that reorients the group toward emphasis in more one area or less resources to apply to something they were already doing. So I think, again, it's a signal here to watch carefully for in terms of what it will mean for their areas of focus going forward.
Okay, well, we've exhausted our time. I want to thank both of you for joining me today. This has been fantastic, very illuminating, lucid presentations. I have a feeling the rest of the year is going to give us much more to talk about. Never a dull moment in Washington, D.C. these days. Thank you for joining us today, Esther, George, David Wilcox.
Mark, it's
Thank you.
very good to be with you, and it's a reminder of what a privilege it was to serve at the FOMC table with President George, if I may use that title.
Thank you, David. Good to be with you both.